Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good afternoon. Ira Epstein of Linn & Associates with your agriculture update for this Wednesday, and we are at the 9th of August, 2017, about 3:30 p.m. Central Daylight Time. So what we had to deal with all day today, of course, was the fallout concerning North Korea and the United States, the threats by both countries against each other and where it's at. At the end of the day, you would have never thought anything happened. Take a look at the stock indices, they're right back. I was on TV today, and both Bloomberg early in the morning and Fox Business, talking about the markets. And I said, you know, every time we get up over 12 in the VIX, before you know it, you're back at 10. You're not there yet, but you only got there today. So you watch. We'll see if I'm right. In the metal markets, are they getting ahead of themselves, or do they know a little bit more and they're going to use this to build on? I can't answer that for you. The dollar down a little bit, not a safe haven there. And what we had today in the bonds and the notes was some gain. But this is an agriculture update. And what's the market going to do? At 11 o'clock tomorrow, we're going to get the USDA supply-demand report that's going to give us a good feel for the acreage that's been planted, be it the corn, the soybeans, the wheat, the cotton, and then we're going to get yield ideas. Going to be very important, and these markets generally move off this report in a big way. So be ready for the action. This was an evening update. The markets did knock out some existing trends, and we've got corrections in other. Example, in the soybean market, we're up for the week so far, 13 3/4 cents. We have what's called an inside week. We haven't taken out the previous week's lower high. We're still in the down thrust of going from 10.27 3/4 to 9.45. My guess is this report's going to set up either a challenge of these recent lows at 9 or back over the 10 level. That's what I'm looking for one way or the other. When I go to a daily area chart of just the closing prices, you're in a down thrust. You've gone from 10.43 1/4 down to 9.56 3/4. This whole rally up has not taken out a previous high close, so I'm still going to be calling that the down thrust. When we go to just a daily bar, not looking at closes, you see that thrust much cleaner. When we put on the swing line study, this 9.79 3/4 is still under 9.81. Now, if the market takes that out, you will have a pattern potentially of higher lows, higher highs. That would be bullish. But until that occurs, you have a bear pattern. Why bear? You have a pattern of lower highs and certainly a lower low. We don't know where this is going to extend just yet, but that's where we're at. When I look at where we're at in moving averages, the first challenge, as is so often the case, under the 100-day average of closes, just didn't have legs under it. It doesn't mean it can't get them if it breaks back under it again. Remember, the market's going to have new information, and chart action right now is based on everything known about the market. What happens when something new comes into play that you didn't know changes the chart. If you get up here, I'm going to look for 993 as resistance. The first break, we'll see if the 964 acts as support because it was hit a couple of times. I'm not sure it would offer that much. I think more likely would be the Bollinger Band if the market's going to fall apart off the report at 950 3/4. We'll see. Momentum-wise, well, the market finished with both numbers under 20 today. Now let's see what they did the day before that. Both numbers under 20, both numbers under 20. That means we have an embedded reading. If the market goes up and takes the slow stochastic over 20, ideally on a close, I'm going to look for 993 to be hit. If the market starts down again and keeps the embedded reading, I'm going to look for the 950 3/4. So you're at an important juncture, but we expected that to be the case. No change on all that. In the DSMEAL, it's the same picture. You have the pattern of lower highs, lower lows. But unlike the soybean market, this market has gotten under the 100-day average of closes in green and been able to stay there. That's a more bearish pattern. You have the embedded reading. Should you get over this 317.70 right here, that could portend a move to 323.90. If you keep the embedded reading, I'm looking for 305.70. Going into the report, this chart has everything about it bearish. In the December soybean oil, you have a neutral chart. Your close was over the 18-day average. You still have the pattern of lower highs and lower lows, and today's high at 34.60 was exactly the same high of the last rally high. So trend down, but the bias up and momentum flat to trying to point up. Going into the report, it looks like they're buying oil, selling meal to me. In the corn market, you lost the embedded reading right back here. This market had to regain it right away, otherwise, watch out. Today was the day that it had a shot, and by the end of the day, instead of breaking further down, it got back up and went right up, as you can see, to that 18-day average. That's 386 3/4. It's 7/8, but you round down because prices are under it, and you went right to it and you stopped there. So we see two layers of resistance above the market, 386, 389 1/4, or 389, either one that you want to call it, and 386 3/4. That's your resistance. If you head down, all you can be in is an oversold condition. Are we trending? No. The only trend that can develop is to the upside. Why? We already know we have a low that's under a previous low. If the market drops down, even if it took out this low, you'd have a higher high and a lower low. But if the market takes out this 388 level and closes over the 18-day average, you could end up with higher lows, higher highs over the 18-day average. You're suddenly bullish, talking $4 in the market. In the wheat market, going into the report, everything is bearish on the chart. You have a pattern of lower highs, lower lows. You have an embedded reading, and the bias is down. The market has played now for almost 2 weeks at that 100-day average, unable to get away from it very much, so this report's going to tell us the next move. In the sugar market, where my eye goes is that I'm oversold. The market does have a pattern of lower highs, lower lows. It is trying to ride the lower Bollinger Band. The chart action is a downtrend, downside bias because you're under the 18-day average, but you are sitting on your lower Bollinger Band in an oversold condition. Doesn't mean it can't go lower, but would you sell into a Bollinger Band? That's up to you. I know in my trading course, I teach never to do that. In the coffee market, everything remains bullish in this market. You have a clear pattern of higher lows, higher highs. You broke down today and came right back, almost closing unchanged. You kept the upside bias, and what else is at work? A bullish crossover that I pointed out to you a couple of days ago, where the 18-day average got over the green, the 100-day average of closes, and the market is under that influence and still pushing forward. In the cocoa market, you had a bullish crossover also, but it went nowhere. And now the market pulled back today, and I think I mentioned yesterday, I said, you know, this market's starting to act weak. We've had a bullish crossover that supports the combination of these two numbers. You fell right into it, but what's the pattern? Lower highs, lower lows, bearish. You're over the 18-day average, upside bias. The two cancel each other out, and momentum's pointing down. I don't know what to do with that. Cotton market, bullish. The market has higher lows, higher highs. The resistance point is very well defined, 71.69 to 71.39, the 100-day average in the upper Bollinger Band. You have an embedded reading. Obviously, if you lose the embedded reading, I'm going to be talking these numbers down here, 69.27. But I'm going to repeat what I've said before. When you go into the big-time USDA report, not every report's a big one. This is a big one. I could never tell you what to expect. You know, the market reaction is going to be the market reaction. In the cattle market, we still see this market under a bearish influence. It is oversold, trying to embed, riding the lower Bollinger Band. For those of you that get our chart of the day, we gave you a number, and one of the numbers this market could be setting up is substantially lower than when you're here. I mean, substantially lower. If you get it, you know what I'm talking about. If not, shame on you. It's free. You could have signed up for it. Your 18-day average is getting ready to go under the 100-day. Now, I hate when that occurs when you're already on a Bollinger Band, but that's what's happening, and we'll see if the market can get more legs to it. Feeder cattle, nowhere near embedding, just an oversold market that's under the 100-day average again. Now, previous times we've hit it, we've been able to bounce away from it as we approach it. This is really the first time it's under it. That could have some meaning. I am not keen on selling a market short the first moves under the 100-day average. I don't mind selling if it gets back up to it, but selling it deep under it often has been painful in my trading experience. You are oversold and it's not trending. The bias is clearly down. Hog market, it has no trend. You've got a pattern of a higher high and a lower low. Now you might be able to get a trend developed from this action, but you're not there yet. You still have the 100-day over the 18. We haven't turned up and you're overbought. This is what I'll call an ugly chart, one that I don't know how to do anything with. Remember, I told you the August issue of Modern Trader was coming out, and here you go about the trades. Now, as you can see, it's chemical trades. This is a restaurant issue. You're going to hear a lot about restaurants. The Fed curve, though, is there. You're going to see the VSAT, a flawed planning broadband company that went bad. And then you're going to get into other areas, techniques and tactics, the golden bracket as it's called. You're going to be able to work with what they call the locomotive breakout. So the magazine is going into a lot more of the fun. I should have gotten out of the way there of some of the graphics as to how they go. They then couple it up with Market Focus, which is their daily publication. But this covers Forex. This magazine is going to get you into the stocks. It's very heavy into what the cattle is doing and the impact on restaurants and how this is all going. And I know in Chicago there's a steakhouse on every corner now. It used to be like the banks. But that's the trades. This is the techniques and how you work with them. Symmetry, harmonic patterns, Renko bricks, what are they, explains it all. And then all the other places that you can work with, including new media books and other areas for you. You get a one-year subscription for free by calling us at 866-973-2077. You can also go to our website at www.iraepstein.com. You will see a carousel of free offers. Click on any of them, and a form will appear. This will certainly be in there. You can click right up here if you're watching me on YouTube, or underneath us. On many websites it says, click here for Ira's free offers. Do so, and we'll be certain to get you up. I'm Ira Epstein. You have a good day, and I'll talk to you all tomorrow.